I want to do a quick review of an Amazon trade that I closed out Friday. I talk a little bit about why I entered it. It didn't really meet the goals of what I would consider for my swing trading. I just really liked the volatility in it, and I thought the price would hold up a little better. What you have here on the screen is a chart of Amazon. You can see I entered the trade right here where this circle is at 103.92. If you're looking at it strictly from my swing trading rules, there's a couple of reasons it's not good. It was not a good trade from that standpoint. One is this gap up. I don't like the gap ups when I'm trying to set up a swing trade. Secondly, it was still over this Bollinger Band here when I entered it. It was still away from this wave, and this really sharp move up in the wave is not ideal when I'm swing trading. I'd rather see it a little more gradual, pull back into it. And then finally, of course, you can see we hit that 200 here, and then we immediately rejected hard off of it the next day after the gap up. So you actually got the gap fill coming back down. Now, why did I end up taking this trade? Well, there are a couple of reasons. One is we got this gap fill here. And although this is a really ugly candle with this real tall wick here, which suggests there will be more downside pressure, which there was, I really felt that we had dropped back into this area. We had the gap fill already, that maybe some of that momentum had run out. Ultimately, though, Amazon is going to do what the NASDAQ does. And the market had downward pressure, so that continued this downward pressure. There were signs that was going to happen. You look at this candle, you see how extended it was. And I knew that when I entered the trade. But there was a lot of volatility here. And I trade Amazon a lot. I wanted to take advantage of that volatility by selling, either a put or a call. What I ended up doing was selling a deep in the money covered call. So I purchased Amazon in this area about 103.92. And I sold my call down here at 92. So it's right in this area right here is where I sold the call. So I sold that 92 call, sold it about 21 days out. That gave me a break even of 91.32, which was right here. As I looked at it, yes, I knew there could be some downward pressure, but I was way down here at 92. I had this wave supporting me. I had the Bollinger Band supporting me. I had my moving average supporting me. For the most part, all of that failed. But because I was very, very conservative on my entry down here at 92, I was able to get out of this trade at almost full profit, at almost what I was looking to get out of it. So it was still profitable, even though I didn't follow my swing trading rules, even though I traded after this gap and this ugly candle. What I did do is take in consideration how far down would I have to be in order to try to get a safe trade. Truthfully, it fell further than I thought it would. I really thought we would get support in this wave here and around this Bollinger Band. I thought it, because here it came in, it started chopping. I was like, yes, it's done more or less what I expected it to do. But the weakness in the market eventually did drive it down. Not a big deal. It was still profitable. I still had it in an area that I wanted to have it in. Everything still worked out for me. But these are things you have to take into consideration when you're deciding what kind of trade you want to enter. If you're going to take a chance and enter it when it's in a bad spot or it's got bad price action, then you better be really conservative so that you have a lot of room. I also try my best to trade stocks that I wouldn't mind owning at the level I'm short at. Here I was short at 92. Figured that'd be a great area to own it, so I was good with that, especially considering my premium on that call. I was really around this area, 91.32 area is where my break even was, which I was well above. And we'll go over the trade sheet now. This is the trade sheet. You can see I entered it at 103.92. This is what I'd use to calculate what my return would be on this trade. On these deep in the money covered calls, especially on the member portfolio ones, I usually use this to get an idea. I like to see this between 15 to 20% ideally. This was 14.55 is what he was estimating for 21 days, potential $77 return. Now you will notice right here, I have a 17.55 return versus this 14.55. The reason for that is on this calculation, it uses my total potential loss as the amount it's going to base the annualized return on. On my trade sheets, I used how much buying power that it actually used in my account. This trade only used about $6,500 of buying power, so I upped it to 7 just to give me a little wiggle room and so that I don't overtrade in the account. Because I can still enter more trades and use my buying power, I use that as my risk or my buying power on this one. And that gave me a 17.55% return over 21 days. Typically, when I enter these, I'll set a good to close order about a nickel to 10 cents below the maximum target price, which is what closed here. It actually hit the close on the 24th, which is the same as the expiration date. If it's way out of the money still, or way in the money still, a lot of times I will cancel this and just let it get assigned and take the full profit here. Because Friday there was still a lot of downward pressure on Amazon, I elected to leave this good to close order out, and around noon it hit. So I made $70 on it if you only traded one contract. I'm sure other people traded more contracts, so I sent this out to members to trade. 1% return on the buying power used, 17.55% return on the buying power used. Just kind of let you know, I immediately after I closed this trade, I went ahead and entered another Amazon trade, and I think the break even on it is around 86 or maybe 84.5, I believe is the break even on it. So I'm still in Amazon. I'm taking advantage of the volatility, trying to get as much premium as I can. Trying to make as much as I can as safely as I can, which means I'm staying deep in the money, primarily a function of the market. You can see from my formula here, it was telling me I should have sold the 98 or the 99. If I had done that, I would have had a lot more potential for annualized return. It would have been much greater. My potential profit here would have been much greater. But because of the price action of Amazon that I showed you earlier, and because I really do not trust this market, I'm trying to stay super conservative, shoot for my 15 to 20% returns and move on. If you have any questions, let me know. Please like this video, subscribe to the channel. If you want to know more about my swing trading, I have some links down below that you can click to see my swing trading book. There's also a book on covered calls. In that book, I don't cover the deep in the money covered calls really. Primarily because when I wrote the book, I wasn't trading those. I was following more of this formula, and as the market is becoming more unstable, I have dropped how I trade. I've dropped the calls to much more deeper in the money calls. Anyway, let me know if you have any questions. Please put it in the comments. Thanks.